got quite a stack of sources today, really digging into what happened around that FOMC meeting. We're looking at central bank moves, some shaky data, and these big shifts in global markets. The mission, give you the quick take on the politics behind the policy right now.
Exactly. And when you piece it all together, you see this underlying worry. It feels like policy decisions aren't just technical anymore. The data itself seems compromised, and that really pushes monetary policy into a political space. That's what we need to look at.
Okay, let's jump right in. First source is titled, Careful What You Wish For. This one highlights just how certain the market was before the cut, like 98.1% probability priced in for 25 basis points down. The focus seemed totally on unemployment, not inflation. Equities, gold hitting records.
Right, but the crucial point this source makes is historical. It's fascinating, actually. Over the last 30 years, every time the Fed kicked off an easing cycle, the U.S. equity market corrected. Every single time. So it really makes you wonder, is the market cheering the cut itself, or is it reacting to something the Fed might see coming? A necessary slowdown, perhaps?
That potential for correction feels even, well, riskier when you look at the data they used. Which brings us to the next piece, all in. This source is really skeptical about the metrics. Take the payroll numbers. The recent correction basically cut the job gains over the last year and a half. A 50% error margin on jobs data. That's significant.
It is. And it's not just jobs. The source points out that for inflation, 36% of the goods in the CPI basket are now estimated, guessed, essentially. So if your inputs are that, let's say, fuzzy, the decision itself stops being purely economic. It becomes, well, almost political theater. And you see that amplified, potentially by new Fed governor nominees who seem more aligned with the White House, blurring those lines between fiscal and monetary policy.
Right, which connects perfectly to the actual vote discussed in dot dispersion. Okay, so they did cut by 25 basis points down to 4.25%. But the dot plot, where each member anonymously puts their rate forecast, showed huge disagreement. Some members' views were almost 300 basis points apart. That's massive divergence.
Yeah, that dispersion really shows a lack of consensus. And the source flags the political angle quite directly. You had a new appointee, Stephen Mirren, whose dot indicated a desired rate seemingly detached from the current inflation or jobs data. Plus, the Fed chair himself sounded quite hawkish in the press conference, suggesting maybe this isn't the start of that long, easy money cycle everyone wants.
Yes. Okay, let's zoom out then, because it's not just the Fed, right? Let's bring in coordinated cuts and global central bank easing. In just 1 week, 6 central banks cut rates. And year to date, 27 cuts globally. That's a lot of liquidity being pumped in.
It is. And what's really interesting, or maybe concerning, is that many banks are easing, even when their own inflation numbers are actually ticking up. Our sources suggest a couple of possible motives. One, trying to stop their currency strengthening against the dollar. Or two, maybe facilitating debt dilution, paying back debt with cheaper currency, kind of a soft default. History suggests central banks coordinating like this. Well, they sometimes cause crises more than they prevent them.
So how does this global flow hit the U.S.? Let's look at the dollar hedge.
All right.
U.S. ETFs pulled in $825 billion in net inflows this year. So the U.S. market is still seen as the safe place to be, especially with all the AI excitement.
Definitely still the destination. But here's the twist, the key thing from this source. For the first time in, well, decades, foreign ETFs investing in the U.S. are currency hedged. Hedging means they expect the dollar to weaken. So the trade is buy U.S. assets, yes, but bet against the U.S. dollar itself. Maybe they think dollar weakness is coming by design, to help U.S. manufacturing compete.
And finally, this all loops back to debt, doesn't it? The source downgrades. Rating agencies are starting to react to countries' shaky finances. Fitch downgraded France, AA to A. And the sources hint the UK, maybe Japan, could be next.
Right. And when sovereign deficits rise, that pushes up government bond yields. That risk then bleeds directly into corporate borrowing costs. Spreads widen. This kind of action suggests that maybe sovereign credit risk, the bedrock of the whole system, might have bottomed out for this cycle. We might be seeing the turn.
So wrapping this all up for you listening, what's the takeaway? We seem to be in a global easing cycle, yes, but it's driven by policy that looks increasingly political, and it's built on data that's, frankly, questionable. That combination carries some serious historical baggage risks of market corrections, and this idea of global debt being eroded through currency weakness.
Which leads to a pretty fundamental question, doesn't it? If the world is sort of defaulting softly via currency devaluation, what actually holds value? Especially when trust in both government bonds and the economic data underpinning them is shaky.
And one last thought for you to chew on. If a nation's debt burden dictates its credit rating, as we see with France, how long before the issuer of the world's reserve currency faces similar scrutiny over its own massive deficits? Something to keep an eye on.